Mastering the Market Cycle by Howard Marks. If someone tells you some chronicles about how much they predicted the market cycles which enabled them to make millions or even billions, then, believe it or not, you might want to do your research before putting your money into following their predictions. We believe that everyone should know about the right way of looking at the market cycles instead of relying on some traditional pundits, which will lead you into an abyss of financial devastation. Howard Marks is the co-founder of Oaktree Capital Management, which is the largest investor in distressed securities worldwide. For years and years, he has worked on market cycles and how an average investor can make decisions accordingly. All of his wisdom is compiled in a single book, Mastering the Market Cycle, and even the greatest investor of all time, Warren Buffett, has acknowledged the latter's approach towards the end of the market cycles. In this video, we're going to break Howard Marks' approach towards stock market investing so that you guys can learn more about investing the right way by studying market cycles. Many people simply miss the chance of earning big due to their indecisiveness and lack of knowledge and awareness. Understanding the market cycle is a big step towards spotting the stocks with great returns in the long run. But for that, we need to understand that the best dividends are always paid by knowledge put to work. So make sure you watch the video till the end so you don't miss out on anything. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. A stock market is a place where your understanding of the market will be put to test. And this is a test that can cost you some serious money, let alone grades, if you're ordinary or way too casual with your decision-making. In this video, we're going to uncover the secret of timing your investments in the market. Coming back to the story where you lost some serious money when your portfolio took a jab, followed by a vicious uppercut which left you seeing sparrows. The US-China trade war made you sell most of your stocks simply because you couldn't stand looking at all those red figures every morning, watching your hard-earned money slip out of your hands. Now, this is a point where you should have held on to your stocks instead, or even put some more money in them, as the market was soon soaring to a new high. You see, now you have to start all over again. You want to invest again, but you find yourself asking these questions. What if your portfolio takes another hit? What if another crisis is just knocking around the door? What if you don't even know if it's the right time to buy stocks? You want to make things clearer for you, right? You want to be able to tell if the market is moving towards a bull or a bear and act accordingly. In other words, you want to master the market cycle. Now, let's put it straight. In investing, no one can tell what's gonna happen, but you can tell us what's likely to happen. That brings us to the 5th most important takeaway from Howard Marks' book, Mastering the Market Cycle, which is to understand tendencies. Let us just say that you get an opportunity to participate in 3 lotteries. All of these follow the same rules, at the cost of $1,000. Now, the lotteries are all about drawing out a ball from a bag filled with 10 balls. If you draw a white one, you get $3,000. If you draw a yellow one, you will get your induction fee refunded. And if you draw a red one, you get nothing. Now, which lottery should you go for? Lottery A has an expected payoff of $500 per ball drawn. Lottery B has a zero-sum game, and Lottery C has a negative $500 payoff. So it's quite straightforward. Going for Lottery A would be the best option. You should notice that even though Lottery A is the best option and the superior lottery to participate in, there's no guarantee that you'll win any prize, but there is a tendency for it. No doubt you can draw a red ball, but the option is not very likely. The same is true in stock market investing. The intelligent investor is always able to tell which stocks have a higher probability of bringing back some profits, or which bag holds the white ball. It is important to understand that the mediocre investor just chooses a bag at random. Sometimes it will contain red balls and sometimes white. Sometimes you will be attracted to companies that will yield high returns, and similarly, sometimes to the companies which are yielding negative returns. Not to mention that there are times when even the mediocre companies are yielding high returns, and times when even the superior companies are yielding negative returns. Therefore, you must now learn when the tendencies are in your favor and when they are against your plans. The fourth important takeaway from Howard Marks' Mastering the Market Cycle is the introduction of the cycles. When you saw your portfolio crash by 20% in late 2018, you witnessed a stock market cycle in action. You also remember one of your friends making millions of dollars from the dot-com companies, just to lose it after some time due to a market crash. It is important to understand that the stock market isn't the only system that shows this type of cyclical behavior. We see different seasons in weather coming during different times of the year. Similarly, many phenomena of physics are based on this principle, and even success in one's life can be argued to follow this point. According to Howard Marks, a cycle revolves around what's known as the secular trend, a standard that can be taken as a midpoint so that the investors can make their investment decisions according to this standard rather than relying on those highs and lows. Most cycles show the following trend: from an excessive low to the mean, the continuation past the midpoint to the extreme high, reaching the extreme high, a reversion back to the mean, the continuation past the midpoint to the low, and then finally reaching back the low. And the cycle continues. An important point over here is that these points aren't just following each other, they are following each other. The stock market can also be taken as a pendulum. It moves from optimism, greed at high prices, to pessimism, fear, and low prices, and the cycle repeats. Warren Buffett, the greatest investor of all time, puts it that what the wise do in the beginning, the fools do in the end. Greed and optimism cannot continue to infinity. It cannot deviate forever from the secular trend. Stocks become too expensive relative to their earnings, and when investors turn more risk-adverse, the next crash comes lurking around the corner. Now the next step remains about how to identify these excessive highs and lows in the market cycle. But first, you must learn that the stock market does not function in isolation. So that brings us to the third takeaway: what influences the market cycle? The market cycle doesn't work in isolation. The pattern which is followed by the market is a very dependable one. The cycle is influenced by 4 other major cycles. The first cycle is the economic cycle. The main influencing objective in this cycle is the GDP, or the gross domestic product of a country. This can be calculated by multiplying the number of hours worked and the productivity per hour. Now it is important to know that the economic cycle is disrupted by various factors. Some of the most common are demographic movements, the unemployment rate, and globalization, among other things. The next cycle is the cycle of profits. The profits of businesses are one of the factors by the help of which the prices of stocks are determined. One of the most common indicators to determine if the prices are high or low is the price-earnings ratio. The total sales of all companies in a country are defined by definition equivalent to the GDP of that country. But there is one thing to keep in mind: profits fluctuate much more than the sales. And the main reason for this is the leverage, both in the operations and the financing of a company. Then we have the credit cycle. Credit is very important to companies in the stock market. It can be used to speed up the growth of the companies, and similarly, it is necessary to roll over old credit. Not being able to get under new debt can cause companies to default when they're required to fulfill some old obligations. It might be a sarcastic remark, but most people and companies don't plan to repay their debts. Howard Marks explains that prosperity leads to expanded lending, which in return leads to unwise lending. The second takeaway is the temperature of the market. Our position in the market can be determined by 2 factors. Firstly, you should see the performances of companies and determine if they're out of line with the historical trends or not. This is very important because if there are no deviations from the trend, the market is not close to an excessively high or a low. And in that case, there is no need for a second step. You should also take note of what the investing community around you thinks of the risk. The most commonly used metric for valuations in the stock market is the price-earnings ratio. You can always track this down at multiple.com and check if the ratio points towards excessive high or low by looking at the columns, the right column and the left column. Now that you know how to spot highs and lows, you are in a good position to learn how to respond to that information correctly. Finally, we've arrived at the first point: aggressiveness versus defensiveness. The thumb rule is quite simple. By making use of all the information at hand, firstly, you will determine if you're in an excessively high or a low. If you're lying down in an excessively low market, you can plan your portfolio to be more aggressive. By that, we mean that you can risk more of your capital, hold lower quality companies, and make investments that are highly dependable on a good macroeconomic outcome. You can also use financial leverage. By using an aggressive approach like this, you've made both a profitable swing and a very costly swing. Luckily, now you know about the temperature of the market, and you're now familiar with the tendency for a positive outcome. But what if you find out that you're currently in an excessively high market? You can tilt your portfolio to be more defensive instead. Now you can plan to hold more cash instead of stocks, invest in safer stocks, buy strong companies that are not cyclical, and stay away from financial leverage. With this approach, you've made profitable and very costly swings both less likely, as you were prone to a negative outcome. Howard Marks's financial wisdom has changed the way people think about stocks and strategize their portfolios. But understanding stocks the right way is an investment that will provide you with the best dividends in the long run. Remember that knowledge put to action is the best product for any value investor. This is the reason we've provided a free guide in the description below, which will explain the 6 stock categories in detail that are important for every value investor to understand. Check out the video we handpicked for you, and we'll see you in the next one.